Good afternoon, and welcome back to the weekly market analysis for the week ending November 4th. Once again, be sure to hit the like button and subscribe to the channel if you haven't yet. You can also follow me on Twitter if you want to see more analysis throughout the week. Today, we're going to talk about a lot of the big moves happening this week. We have the dollar making a really big move down today, almost 2 whole percent. We'll talk about that in just a little bit. We've got a lot of headlines on the week that I want to walk through. The first thing, just kind of overnight, we have another rumor. It's the second one this week about China reopening, maybe potentially shutting or going back on their zero COVID policy. And so we saw a huge rise in, like for example, the Nasdaq Golden Dragon China Index was up 8%, over 8% today, almost 9%. You had Chinese companies like Alibaba, which was up. Let's see, what are we up today? Up 7% on the day, which is kind of funny if you just look back at Alibaba since 2020. It's been down pretty deep. So it's really interesting to see everybody getting really excited about this. Alibaba is still over 75% off its high. It's kind of interesting. There was some other discussion about how U.S. officials wrapped up some audits in Hong Kong, and so there was a lot of fuel adding into the move in a lot of Chinese stocks on the day. So that was a big deal. That had a really big impact on crude oil, which, if we zoom in on crude oil was up over 5% on the day. Still looking like it's made its bottom and working its way up. What we'll be looking to see is if we get a higher high above around 93 and a half. If you're risk managing, if you think that because of impending recession that that we're not going to see bullish price action, we're actually going to see it come down. There are some who are thinking that then this is the level that you manage your risk off of if you're taking a trade to the short side. I personally don't think it's going there, but that is something I did want to call out. So going back to the DXY here, big down day. The biggest move was in the euro. The euro was up over 2% versus the dollar today. Again, we had broken out. I don't think I had this chart up last week, but we broke out of this downtrend. So now we have to get rid of this, and we'll be watching on the underside to see if we get to see how much momentum we get on this trade, or on this trend, I should say, excuse me. So as you can see, I'm adding this trend line here because we're going to be watching to see if this is going to be a flagging pattern. You can kind of see the symmetry there. So we're going to clone this on the euro and put it right there. Be watching this, which is really interesting because the DXY, you can see I've got the same kind of flag going on here. It looks like, I mean, we're still in an uptrend. Obviously, the uptrend has been since mid 2021, so I want to call that out. We did close back below the 50-day moving average, which is a really good spot usually to lean in, or it has been on this uptrend. I do want to call out one other place where the price action consolidated over a period of time back in November, December, and into January of this year, where we came below the 50-day, popped back above it really, really quickly, and then came back down below. But then we did end up resuming back up. I do want to call that out. But other than that, it's been a while since we've had a double cross of the 50-day moving average. I mean, like I said, we're getting almost to, it's been like 10 months or so, or 11 months since we had that kind of a cross or a double cross. So that is something I do want to be aware of. But unless we make a lower low, which is possible, but unless we make a lower low, then this is not something that you should be chasing to the downside. It's actually really interesting. You can manage your risk pretty easily off some of these levels using either the bottom of this green wick or potentially the bottom, maybe this red wick right there, to manage risk off of. So you can potentially take long US dollar trades with this as kind of a proxy. And so let's take a look at what that looks like on the euro first. So the level to manage risk off of would be right here, just above that, the top of that red wick. So if you wanted to watch for the short side, you could either look at that level on the horizontal, from a horizontal standpoint, or you could go off of the top of this trend line. Once we get there, then the question is, what do you use? If you start to see price stall out here, then you can either use the top of that wick, or you can use that line right there just at about 1.02 as another level to manage risk off of. But you definitely don't want to be taking the longs on the euro here. I do want to point that out. Let's take a look at the dollar yen. The dollar yen did not have, I mean, it was down 1%, but not quite as big of a move. This is kind of what I'm watching here on the yen. Pardon the crazy drawings right there, but that's kind of what I'm watching there. It's just a consolidation. It's nothing more, nothing less at this point, kind of similar to what we were seeing back in April and also back in July and into August of this year. So I do want to call that out. And then the British pound, we did get a little bit of a breakout over the last couple of weeks. I haven't really talked about this in a little bit. We did not get the engulfing candle like we did on the euro. So the level to watch is, oops, sorry, that was really bad. The level to watch is going to be right there to manage risk off of. And then possibly if you want to watch, an ascending trend line right there, you could watch something like that to manage risk off of. I'm not personally, but I do want to call it out and be aware of it. So the big moves, obviously, versus the of the euro and pound and yen versus the dollar are obviously the biggest reason for such a huge drop in the DXY. I don't think that it's the bottom. In fact, I keep calling out on Twitter that this is going to catch a lot of people off guard. I think that a lot of people are waiting for it to waterfall down, and I just don't see that that's going to happen. I think it's going to maybe bounce around a little bit down here and then come back up and actually break to new highs. And it doesn't have to do that in a straight line. It can take time for that stuff to unfold. So the place where I'm going to start looking for potentially the full trend reversal is not necessarily to make a lower low here, because that would be pretty consistent for a flagging pattern. But if we break both the ascending trend line, which is kind of a near-term trend support, and then if we break the bottom of the flag, so if we come down, bounce, and then break through, that's where you got a lot of space in between that and the prime trend line. So that is something I do want to call out. But you have a lot of space here. I mean, the dollar can go down to at least 108 before there is any sort of potential concern that this is actually like heading down rather than heading back up. So just want to call that out. The VIX, do want to check out the VIX. What's been really interesting is we had on Wednesday, the Fed hiked interest rates. And so the question that everybody is kind of thinking about right now is when are they going to slow? They did talk in the press conference about the potential of slowing the pace of rate hikes, but also saying that that doesn't mean that they are going to like pause anytime soon or that they are going to cut anytime soon. In fact, the markets responded really interestingly just because of kind of the way that the Fed Powell talked about in his press conference, how they wanted rates to come up higher than even they previously had shown in the SEP in the September meeting. So I think that's interesting. So we'll see at the end or during the December meeting how that is revised. And obviously Inflation numbers will play a role in that, and also jobs reports, which this morning the jobs report came out today. Jobs were expected to come in at or just below 200,000, but we really like blew that out of the water. But what the market was paying a lot of attention to is the unemployment rate shifting to 3.7%, which was up from 3.5%, which is really interesting. Um, what I think is notable is the average hourly earnings rising month over month and then being up 4.7% from last year. And I'll explain why that is in just a moment. But I do want to call that out because that's had a pretty significant impact on the markets this week. Obviously, the S&P down 2.5% on Wednesday's news, but the payrolls report actually was interpreted as being pretty bullish for the markets. I think that that's interesting. I just want to call that out. So the Nasdaq was the worst index. We did come close green by 1.3% today, but on Wednesday we were down almost 3.5%. The Dow, which has been outperforming, was down almost 1.5%. So not nearly as bad as the Nasdaq was. And then on today's news, it was up over 1%. Dow has been the best performing index over the last since the start of October. So that's interesting. And then the Russell also had a pretty sharp down day, 3.4% down on Wednesday, but up 1.23% today. There's a lot of things going on as far as rotations going on. I want to explain that in just a little bit. But even with these market moves, what's been really interesting is to see the VIX continuing to go down. And even on Wednesday, the VIX closed at basically unchanged, down very, very, very slightly. And it's something I've been posting in my newsletter a lot and posted recently on Twitter, that there's not really any fear in the markets. It's very interesting. And I'm not sure if that's a confidence about the possibility of lower rate hikes. I'm not sure if it's the confidence about the strong economy. I'm not really sure what it is exactly, but the VIX is down, and it has continued. Like, look at all these red candles. It's been continuing to be down generally since early to mid-October. Still hasn't made a higher high than back in June or back in May or back in March or in January. But we are not making lower lows either. So that's something I want to call out as well. So there's not a lot of fear. And then going back to the equity indices, I wanted to turn on the moving averages so you guys can kind of see momentum wise what's going on here. Got to get rid of this really quick. You can see that the S&P this time appears to have been stopped by its 100-day moving average. Back on the bounce in August, that ended in August, I should say, it hit the 200. So a little bit lower moving average to bounce off of. And then it came up really close to its 50-day today, but since came off. So that's something I want to call out. You can actually see the 100-day is actually starting to curl a little bit to the upside. So typically that would be bullish if the 50-day was also curled up, but it's not. So kind of a conflicting signal there. The NASDAQ didn't even get close to any of its moving averages. It's the underperformer. The Dow came back under its 200-day after closing above 200-day last week. We called that out on the video last week. But we retested it today and did not, so far have not come back above it on a closing basis. So we'll see what happens next week. And even if the Dow does close above, we still have this trendline resistance that we have to worry about. So you don't want to chase the momentum up here. You've already missed the move if it's up here. So more likely, if you want to take positions to the downside, this is the level to manage your risk off of with your stop loss slightly above. If you're feeling a little bit more like a risk taker, then you can use the top of the red wicks here as a place to manage risk, or potentially the top of the green wick right above the 200-day moving average if you think that that's going to hold. It's a lot more risky, but it is a pretty clean level that you can use to manage risk off of. And then the Russell, getting kind of rejected by its 200-day. and then coming down below the 100-day, catching the 50-day as support, but closing just below. Let's see, we're at 1804.7 on the 100-day moving average, and that is exactly where we closed today. So closing right at the 100-day moving average. So that's going to be a battle right there. And interestingly, the Russell is having a similar issue, a similar situation as was unfolding back in late 2021, where we were calling out the convergence of all of these moving averages and how that was creating a mess as far as figuring out the direction of the market. And we're starting to get that same kind of crowding on the Russell right here, and getting close to that kind of crowding on the Dow. So I'm going to be watching for that, because that is indicative of potentially a trend reversal, a trend change, or maybe a big move even to the downside like it did back in late 2021, early 2022 on these indices. And then as far as the outperforming of the Dow and the Russell, typically, what I'm noticing, or what I've been noticing, is the value versus growth. So the IWD is the Russell 1000 value ETF, and IWF is the growth ETF. And it's definitely outperforming to the value side after having kind of made this double bottom. And I think that's a really indicative of kind of this period of time where we're rotating out of like large cap growth and moving back into value. That's why you're seeing, I think that's why you're seeing the weakness in like the big FANG names. And as another indicator of that, you can look at the IWM, that's the Russell ETF, to OEF, which is the largest 100 companies in the S&P. Instead of it being the S&P 500, it's basically like the S&P 100. And you can see that has started rolling back to the upside as well and starting to outperform. I should say the small caps starting to outperform the mega caps. And so you have basically two rotations happening. You have the rotation out of growth and into value, and you have the rotation out of the mega cap companies into the small cap companies. And so I do want to call that out, because if you're thinking about where the trend is right now that you can kind of slide into as far as trading and investing, if you're on a short or medium term time horizon, this is definitely something that you want to watch going forward. So I wanted to call that out. And then let's take a look at bonds really quick. We have the 10-year Treasury yield that is very, very close to its old closing high, continuing to come up on these news stories of payrolls, and obviously with the Fed continuing to raise rates and things like that. Was really interesting is that you have the TLT, the long bond ETF, that bounced off of trendline resistance. And it looks like it's going to be rolling back over, but definitely want to watch early next week to see if we're actually going to establish kind of a counter trend flagging move or wedge move, something like this, or possibly something like this. Sorry, that's pretty bad, but you get the idea. That's really bad. Sorry, but you get the idea. Something like that. I will be watching for that. Junk bonds, which is a really good indicator of risk in the market. I'm going to get rid of this. Closing up on the day about a little over 0.5%. Not making a lower low like TLT is starting to kind of roll over. It doesn't look like this is rolling over yet. This will be a good way to measure kind of where we are, where we're going as far as the bounce in equities. One interesting development is the 10-year 3-month, which got a lot of buzz last week because it finally inverted. We came back above, so we're not inverted anymore. So that's kind of interesting to point out, because typically the 10-year 3-month curve, if that's inverted, then that signals the recession is coming. So will we get a recession or not? Not really sure. It seems like that's what the Fed's planning for without actually saying it, but I do want to call that out. So, and then the big movers today, really, really big movers today, were gold up, and just precious metals in general. Gold up 3%. Silver was up, I think, even like 5 or 6 or 7% at one point. But gold was up 5 or 3% today, up $50 per ounce. And then, crude oil I already mentioned, and then Bitcoin up a little, just a little under 5% so far. And obviously that's a 24/7 market. So still, that'll trade all weekend. But it's clear that both Bitcoin and gold are making their move, making this move today on the heels of the weak dollar. And so that's something to notice as far as that correlation or that inverse correlation is concerned. So if the dollar does end up turning back up, I would expect to see gold come back down. Gold hasn't made a higher high yet, so there's nothing to celebrate about here. This looks like potentially a rip to sell. So I do want to be aware of that. Let's see what happens if we actually try to draw a trend line here. Let's see if we draw the trend line right there, then it actually looks like we're right into resistance. So, and then it looks like actually also if I draw a horizontal line right there, looks like we're, kind of at a resistance level right now. We closed at resistance on both, so we'll see if that holds. It is something that you'll want to be aware of and watch going into next week. If we get follow through and break out from this, then it looks like the gold trade will be on for a little bit. But so far, all since April, it's been a big disappointment. So not jumping for joy about that. So anyway, that's the look at the markets. And the last thing I want to leave you with is going into next week. Oh, sorry. Let me pull this back up instead. I don't think I said I was going to talk about this. I don't think that this move on the dollar is indicative of any trend change, and there's a couple of reasons why I wanted to mention here. In the Eurozone, I think just to kind of give you an idea of why I hold the position I do, is you have places in Europe that are still looking at spending tons of euros, like using euros to basically try to keep energy costs down for European civilians. And this is obviously an article specifically relating to Italy, but you're actually seeing that floated all across the Eurozone. And then on top of that, you have this kind of like increasing gap between different bonds in across Europe, like the difference between the Italian bond and the German bond. So there's a 216 basis point difference between the 10-year yields, and I think that that's something really interesting because they have to keep that in line. They can't let that get out of control, and that's going to mean that they're going to have to find a way to essentially they probably won't call it yield curve control, but something like it in order to keep that in line, which to me doesn't bode well for the euro. And then it also, the thing about the euro, the ECB as well said that they can't just mirror Fed policy moves. So they can't just hike and do the same things that the Fed is doing. And I think that is one of the more dovish things over the last week that I've heard from the ECB. Even though they also are talking out the other side of their mouth, talking about how they're ready to tighten faster if inflation is becoming more persistent. But they are going into winter, and they do have an energy crisis on their hands. And the only solution that they're going to have to do is print the difference. And so I guess at least part of my thesis about the US dollar is just the reality that I don't expect the Eurozone to get their act together, because they can't. They'll face revolution if energy costs continue to stay high, and I think they're going to print the difference. And then when it comes to Japan, they're not going to materially change their yield curve control policy until potentially March or April at the earliest. So without like substantial shifts in actual monetary policy from not just the ECB or the Bank of Japan, but also from the Fed, without any material difference, it's hard to see how this trend is going to change at all. And so this is a situation where when you get these big pullbacks in the dollar, this is where it's really beneficial to find a good spot to manage risk off of and then to lean in. And that's kind of been, the strategy basically since for this whole year, finding those places, finding the spots where the dollar's pulling back in its trend. So, look at all these spots. These are all great spots to add. Even here, back here, as soon as you establish any trend lines, these are all places where you could have made really, really good trades. And if you just had patience, on all these pullbacks instead of everybody looking for tops, you could have made a lot of gains from looking at that. So I did want to mention that. And then also, speaking of Fed policy, this is kind of the key here. So I have to get rid of some of these numbers. Sorry. So what I did here, just to kind of wrap up this video, is I have down here, if you look at the highlighted yellow boxes, what I did was I put in the forecast month over month CPI, which is going to be released next Thursday, both in headline and in core. And headline is predicted to come in at 0.7 month over month, and core is predicted to come in at 0.5 month over month. And what I want to call out is that if it comes in at expectation, then on an annualized, 2-month annualized, and 3-month annualized basis, both, you'll have headline CPI up, and you'll have core CPI on a 3-month annualized go up. And that's not the direction that you want to go in. And obviously there will be other indicators. Like I've started looking at median CPI, trimmed mean CPI, and sticky CPI as part of my process, as well as I try to think through the Fed reaction function to all of these, to all this economic data. These numbers aren't going to do it, especially on the core CPI. That's not going to do it, especially if that 3-month annualized number actually starts coming back up. And then the other thing I wanted to call out, and I should highlight it because I want to make sure that everybody knows that this is not actual numbers. What I did was I looked back over the last, what was about a year and a half or so of PCE numbers, core PCE numbers, and I looked at the average month over month core PCE measure, and then made a small adjustment based on kind of the recency of some of this data. And on a month over month, the average is a 0.4. And if we get a 0.4 print, then the 3-month annualized core PCE, which is what Powell has talked about in his press conferences, is going to be up pretty substantially. And then if you go one standard deviation lower, which would put it at a 0.2 month over month. If we get a 0.2 print, then that's going to put 3-month annualized at 5.2. That's still not going to cut it. And then if you go at a 0.0, then you're going to have a 3-month annualized that is level. So if month over month PCE comes in at 0, and it did that back in July for the July reading, but if it comes in at 0, then at best 3-month annualized core PCE will be at the same level that it was at last month's reading. And again, that's not going to cut it. Basically, what you would need to see on core PCE month over month to get a 3-month annualized at the level that Powell would want to see for him to think that everything is fine, is you would have to go. You would have to go. What is this? This is like 5 deviations below trend, below the average, in order to get a 3-month annualized core PCE of 2. So at the end of November, we're going to get I think it's at the beginning of December. We might get the core PCE for the month of October. And if that number doesn't come in month over month at negative 0.6, then you should not expect that the Fed will give any indication that they're going to pause anytime soon. And this is just laughable. It's basically impossible. So do want to point that out. I'm going to put this number back in because that's the average. So this is something I want everybody to be aware of. So again, you don't get your hopes up that there's going to be any change in policy because the Fed's been pretty clear about what they're looking at. And as long as As long as payrolls stay hot, as long as inflation stays hot, then we can't expect this, the dollar, we can't expect that to change direction in any material way. And we shouldn't expect assets to do anything other than what they've done since the start of the year. And so that's my update for the week. Thank you for watching, and I'll see you guys next time.